Welcome to Factful Finance, the channel that makes understanding your money a little bit easier and a lot more interesting. Today, we're diving into a topic that's crucial for homeowners feeling the strain of their mortgage: how to qualify for mortgage forbearance. Whether you're facing temporary financial setbacks or just exploring your options, understanding mortgage forbearance can be a lifesaver. Now, here's a surprising fact to get us started. Did you know that nearly 1 in 10 homeowners faced difficulties paying their mortgage during the pandemic? Mortgage forbearance allowed many to temporarily pause or reduce their payments, preventing a financial disaster. But how exactly do you qualify for forbearance, and is it the right option for you? Let's break it down. Before we get into the nitty-gritty, a quick disclaimer. This video is for educational purposes only. If you're seeking advice tailored to your personal situation, always consult with a financial professional. And just so you know, any apps or products mentioned here are not endorsements, just tools that may help guide your journey. All right, let's talk about mortgage forbearance. At its core, mortgage forbearance is a temporary pause or reduction in mortgage payments granted by your lender, typically for financial hardship. It's not a free pass. Payments will eventually resume, and you may need to make up for the missed ones, but it can provide critical breathing room. So how do you qualify for mortgage forbearance? There are a few key requirements, and today I'll walk you through each one with practical advice and real-life scenarios. First up, prove a financial hardship. The most important thing to know is that lenders want to know you're facing a genuine financial struggle. This could be a loss of income due to illness, job loss, or even natural disasters. For example, let's consider Sophia. After losing her job during a company downsizing, she was able to apply for forbearance by submitting her unemployment documentation and proving her inability to make the full mortgage payment. Next, communicate with your lender. This is key. If you're thinking about forbearance, don't wait until you're behind on payments. Contact your mortgage servicer as soon as you foresee any difficulty making payments. Many homeowners, like James, didn't wait until they missed a payment to start the process. James called his servicer, explained his situation, and was granted forbearance before he even fell behind, keeping his credit intact. Third, understand the terms and conditions. Not all forbearance agreements are the same. Some lenders may offer a 3-month forbearance, others 6 months, and some may even grant more time depending on your situation. But here's a crucial point. After the forbearance period ends, you'll have to make a plan to get back on track. There are different ways to handle the missed payments, such as a lump sum payment, an extended loan term, or even adding the missed payments to the back end of your mortgage. Be sure you understand the options and choose what's best for you. Now let's talk about documentation. The lender will likely ask for proof of your hardship. This could include pay stubs, bank statements, or tax returns, anything that clearly shows your financial difficulty. For example, Liam, a small business owner, submitted his income statements to show the dramatic drop in revenue his business experienced during a slow season. One thing you don't want to overlook: credit impact. While mortgage forbearance itself shouldn't negatively affect your credit score, how you manage the forbearance agreement will. If you resume payments according to the plan you agreed on, your credit should remain intact. But if you fail to make up the missed payments after the forbearance period ends, that could impact your credit. Finally, be aware of government programs that may offer additional assistance. For instance, the CARES Act, passed during the COVID-19 pandemic, provided temporary forbearance protections for homeowners with federally backed loans. If you're in this category, you may have more lenient terms. But even if you don't have a government-backed loan, private lenders may still offer similar relief, so don't hesitate to ask. Now let's recap the steps. First, prove your financial hardship. Second, communicate proactively with your lender. Third, understand the terms and conditions of the forbearance agreement. Fourth, gather your documentation. And finally, be mindful of the long-term impact, particularly on your credit. For practical tools, you can always check out online mortgage calculators or budgeting apps like Mint, which can help you plan your finances and make the forbearance process a bit less stressful. Before we wrap up, I want to hear from you. What's your biggest financial challenge right now? Let us know in the comments below. And if you found this video helpful, don't forget to give it a thumbs up, subscribe, and click the bell so you don't miss out on future insights. Trust me, we've got more valuable tips on the way that could be the next step in helping you take control of your finances. Thank you for tuning in to Factful Finance. We'll see you next time with more actionable advice to make your financial journey a little easier.